The ROE is a function of the company's earnings, the profit after tax divided by the shareholders' equity. The growth is a function of the ROE and the retention ratio, that is, how much earnings the business is throwing back in the business back again for growth, expansion, and diversification. And the price to earning multiple has always been a function of the free cash flows to firm, the cost of capital, and the growth rate. That is, when the growth bounds to rise in a business, the spread between the cost of capital and the growth rate tends to get compressed. And hence, the factor by which you are discounting the future free cash flows, it tends to become a smaller number. And hence, the valuation of the firm tends to rise. And ultimately, the value of the equity share in the market also tends to rise in case of the forward price to earning multiple. Also here we need to understand this, that ROE, the return on equity, can be decoded as a ratio of the price to book value multiple and a price to earning multiple. How? If just in case I divide the price to book value multiple by the price to earning multiple. For example, I'll just try to derive this number. Price to book value multiple is nothing but the price divided by the book value per share. I divide this number by the price to earning multiple, that is price divided by the EPS, the earnings per share. Simply this becomes a reciprocal, and I can just take it ahead, that is price divided by the book value per share into the EPS by price, right? Price to price gets cancelled out. So hence I get something as the EPS divided by the book value per share. What's EPS? It's the PAT divided by the shareholders' equity. What's the book value per share? It's nothing but the shareholders' equity divided by the book value. Similarly, the shareholders' equity and equity gets cancelled out. It becomes PAT divided by the book value per share. And this is how I can get the ROE of a company. And that is why I'm insisting on one point, that the ROE of the company is extremely important. We tend to disregard this metric. And ROE is not just an indication of the company's earning growth in the numerator, that is the profit after tax. It also helps you to judge the valuation of a company based upon the company's actual value, company's actual strength, company's actual net worth. Hence, the ROE can be summarized as a ratio of the price to book value multiple and a price to earning multiple, or a ratio of the earnings per share divided by the book value per share. So never disregard the importance of the ROE in your life, because it helps you to judge or to analyze the company's earnings as well as the company's book value.